Welcome. This is Accounting with Bennett Tchaikovsky. Our topic today is the statement of cash flows. We're going to be looking at some additional topics as well as a comprehensive example. This presentation is copyright 2008 to 2018 by Bennett Tchaikovsky. All rights are reserved. To reach me, you can use either one of these email addresses. I welcome your feedback and your comments. So there's some other kind of more advanced topics when it comes to cash flows. And I shouldn't really call it advanced, but it's just we have to kind of treat these a little bit differently. And this is when we're using T accounts to figure out our cash flows. And those topics are non-cash exchanges. What happens when we have a net loss, and then what happens when we have the sale of equipment. A non-cash exchange is when a company is, say, trading, receiving equipment, giving out stock, receiving a patent, giving out a bond. Those are important transactions, but they do not involve cash. And so what we need to do is we need to put those transactions into the T accounts and then go ahead and disclose below what's going on. And that's going to be below on the statement of cash flows. And the reason why we need to put them into the T accounts, because if we don't, it's going to look like that equipment or that patent or the stock or the bond was issued or was paid for in cash, and that's not the case. So the second thing we need to do is when we have a sale of equipment, going back to our discussion on property, plant, and equipment, and please feel free to go back and watch the video that I've created on this. When we have a sale of equipment, we need to remove the asset from our books. And so the general equation we use to record the sale is going to be a debit to a loss. And this is only if we have a loss. The loss here is a plug. I have to remove the accumulated depreciation of my equipment. I'm receiving cash, receiving or getting rid of the equipment from my books, and I'm going to credit a gain if I have a plug. The first thing I do is I'm going to post the accumulated depreciation and the equipment into the T accounts when I'm doing my analysis. When I'm showing the cash being received, I'm going to show this as a debit to investing activities. It's going to be sale of equipment. The loss is going to show as a debit to the operating section. The gain will show as a credit to the operating section under cash, under operating activities. And here's where we get funky. And again, this is by far the best way to do it. You prepare the journal entry and then you post directly into the T accounts. Why are we adding back the loss? And the reason is that inherently this cash that we're showing already reflects the loss in it, or at least the cash that we're putting onto our statement of cash flows. Therefore, because net income already has the loss factored into it that we're starting out on our statement of cash flows, I need to add back the loss. And conversely, the other side of it is going to be for the gain. Do you need to know that? Sure. I mean, I don't know. I think that for a first-year accounting student, this is probably the best thing to memorize, and then you go through and you post it up through the accounts. So we can go into theoretical land, but I think you'd rather not do that. Okay, so we're going to talk about today what happens when a town doesn't do stadium renovations, and they're going to move to Tustin. Oh, excuse me, it's the Tustin Angels, Inc. There we go. Haha, not funny. Okay. All my friends, whenever I say that Mike Trout got traded or I make up this stuff, they really get upset with me. So I apologize for that. So we have this, the Tustin Angels of Anaheim, and this is more of a comprehensive example. And here we go, wow, like never ends. So what we're going to do is we're going to take this balance sheet and we're going to put it into the T accounts. And I'm also going to go through and I'm going to set up my skeleton cash flow. So I'm going to take a quick break. I'll come back and have this done for you. And we're back. So what I've done here is I have put everything that's been in the balance sheets into the T accounts. And I've also created the skeleton. And for the skeleton, we had a beginning cash balance of $5 million, an ending cash balance of $4,025,000. So I know my change has to be $975,000. So let's go ahead and take a look at this. So my key focus here is going to be on all the various T accounts. Remember, accumulated depreciation on equipment is going to have a credit balance because it is a contra asset account. Discount on bonds payable has a debit balance because it is a contra liability account. And we're going to go ahead and start right here with my additional information. So Angels had net income of $250,000 for the year ended December 31st, 2021. And hold on. Let me just check something real quick. I think I may have screwed that up. I believe it should be net income of $350,000. There we go. Okay. So Angels had net income of $350,000 for the year ended December 31st, 2021. So for the net income, I'm going to go ahead and put that right here. So what do? Well, once I have the net income that goes into retained earnings, I do the opposite to cash. And here I'm going to describe this as net income. And this is going to be a debit for the $350,000. Okay. On December 30th, 2021, Angels issued bonds with a face value of $550,000 and a stated interest rate of 5%, which resulted in net proceeds of $500,000. Now, if I were to be doing this as a journal entry, and I would actually probably recommend that you do it this way, for number 2, when I have a bond that's being issued at a discount, the journal entry is always the same. I debit the discount on bonds payable, I debit cash, and I credit bonds payable for the face amount. And what I'm going to recommend that we do here is, so I'm going to create the journal entry, and I'm going to go ahead and post it directly into the T accounts. So the discount on bonds payable, this here was a debit of $50,000. I had a credit over here of bonds payable for $550,000. And at the same time, the cash proceeds from the sale of bonds payable is going to go here at $500,000. Now, another way you could have done it is you could have said, oh, I credited bonds payable here for $550,000, so I have to debit basically the bonds, or in the financing section, debit this $550,000. But I have here the discount on bonds payable, which is a debit, so I'd have to credit cash for $50,000. The net amount of these two is going to be the cash proceeds from the issuance of the bond. And we're going to give ourselves a little bit more breathing room here. Okay. Hopefully we get this to work, and there we go. Okay. So that's my transaction 2. The next one is that Angels declared a dividend of $50,000 to its common shareholders. So when I have a dividend, and if it was paid, I'm going to be debiting retained earnings because that's how I handle my dividends. And I'm going to credit cash because I always do the opposite to cash. And here, this is going to be dividends. Dividends paid of $50,000. Okay, so we have that there, and we can just kind of go through and do some highlighting here in case we want to go back and take a look at the work. And we'll just kind of put that right up there. This $500,000 is really coming from this journal entry, but at the same time, it's also really the net amount of these two transactions. or the right over here, the discount, and I'll just kind of highlight all these down here so we can kind of see where those are coming from. Okay, so, and again, to go back to this bond part one more time, and I apologize for this, I just want to make sure I'm clear. If I write here, if I'm doing the opposite to cash or debiting bonds payable for $550, and then I'm crediting discount here for bonds payable of $50,000, what I'm left with is a net amount of $500,000. And what I want to be showing on our statement of cash flows is the cash proceeds. So the better way to do this, instead of describing, oh, an increase in bonds payable of $550, and then you say an increase the discount on bonds payable of $50, we're just going to write this here as sale of bonds for $500. So there we go. Okay. So over here, and then let's just kind of do this one for the net income. There we go. Number 4, Angels received $100,000 worth of equipment and issued $100,000 of bonds payable at face value. The bonds have a stated interest rate of 4%. Okay, this is what we call a non-cash transaction. And the reason why it's a non-cash transaction is because Angels here is receiving equipment and then issuing a bond. So the way we want to handle this is we're going to go ahead and do a journal entry. We're going to debit equipment for $100,000. And at the same time, we're going to be crediting bonds payable for $100,000. So this is going to be what we call a non-cash transaction. And what I'm going to do is 2 things. The first thing I'm going to do is I'm going to post this into my T accounts. So I'm going to go up here. I'm going to say equipment. And I'm going to make myself some more room. Okay, and we're back. So what I'm going to do here is I'm going to increase my equipment by the 100,000. Okay, and at the same time, I'm going to increase my bonds payable by 100,000. But notice here what is incredibly important as we're going through and looking at this is that I'll do a little bit of a different color. There we go. Is that when we're going through and doing this question, this is what we call a non-cash transaction. So there's really no cash that's being impacted here. So what our rule is going to be is that we're going to create the journal entry, and at the same time as well is we're also going to be, let's put this in here so we're all following along colorfully. The other thing we're going to be doing is we're going to be disclosing it as a non-cash transaction. And if we want to go ahead and do this, what we can do is we can just go over here to our statement of cash flows and list this out and say that on December 30th, 2021, Angels received $100,000 worth of equipment and issued $100,000 of bonds payable at face value. So again, we put it into the T accounts and we describe it, which is going to be in the non-cash transactions. But more importantly, when we're going through here, we are not doing the opposite to cash because it is a non-cash transaction. So for non-cash, we put it into the T accounts, but that's going to be it. Okay, and we're back. And for fun, what I've also done here is I've added on 2 additional questions which have to deal with equipment sales. So we've dealt with the net income in terms of the additional information. We've dealt with the issuance of bonds. We've also dealt with the dividend, and we just did the non-cash exchange here. And what I've added to this question to give it a little bit more fun is an equipment sale. So let's go through and do this and remembering what our rules for equipment are. So when I have a sale of equipment, the general form of my transaction is going to be a loss, accumulated depreciation, cash, equipment, and then a gain. And so this is going to be the format I'm going to be using here for the journal entry. My accumulated depreciation was $10,000. The equipment cost me $25,000, and my cash here I got was $5,000. So similar to the other questions involving accumulated, involving an asset sale, what I then do is I say, okay, if it cost me 25 and it had accumulated depreciation of 10 and I'm selling it for 5, so that means I have a book value of 15, or the equipment minus the accumulated depreciation, I'm selling it for 5 and I am going to have a loss of $10,000. Going back to our previous rules is that what I'm going to do is I'm going to post this directly into the T accounts. The loss is going to go as a debit in the operating section. The accumulated depreciation and the equipment are going to go into the respective equipment and AD accounts. And then my cash is going to go into the investing section as a sale of equipment. So let's have fun. So here I'm crediting equipment for $25,000. And we're going to go ahead right here and do this. I'm debiting accumulated depreciation on equipment for $10,000. And we'll go ahead and make that a nice blue highlight. And I'm going to be proceeds from sale of equipment. This right here is going to be $5,000. And then I'm going to have here, lastly, I'm going to have a loss on sale of equipment, and this is very important, of $10,000. Okay, and please see the earlier part in this video if you want to better understand why we're doing it that way. Okay, and this is my cash T account. Okay, so that's what we're going through and doing. Now, the next thing I'm going to be looking at here is number 6. I sold more equipment, and this additional equipment that I sold here. Okay, so I sold equipment costing $10,000 that had accumulated depreciation of $8,000 for $7,000 cash. So my rule is here, equipment cost me $10,000. I received $7,000 cash, and I had accumulated depreciation on this of $8,000. So here, I'm going to need to balance my equation. I'm going to have a gain of $5,000. And so what I want to do with this is I've got this right here. What I'm going to do is I'm going to go through, I'm going to post this directly into the T accounts. The accumulated depreciation of $8,000 is going to go directly into that particular T account. My equipment, which cost me $10,000, is going to go right here into this T account. And again, I'm just going through and posting the entry. I had a gain on sale of equipment, and this here was going to be a credit balance of $5,000. I'm going to go ahead and show that here. And then for the investing, I have proceeds from sale of equipment of $7,000. I'm just going to go ahead and check that number just because I made it up. And let's take a look. Did we get it right? And yep, perfect. Okay. So we've gone through and we've dealt with the additional information first. Now what we have to go through and do is analyze each of these T accounts individually. Remember that our overall goal is we want to have a total decrease in cash of $975,000. So with accounts receivable, my rule is, what do I need to do to balance? Here, I need a credit of $100,000. So if I'm crediting this account, I'm going to do the opposite to cash, or have over here a debit for the $100,000. When it comes to the description that I use, I talk about what happened in the T account. So a decrease in accounts receivable. For inventory, to balance this T account, I need a $200,000 debit. So I do the opposite to cash, or a credit of $200,000. And this is going to be an increase in inventory. My prepaid expenses increased by $25,000. So here, I'm going to do the opposite to cash, or credit cash for $25,000. I'm going to call this an increase in prepaid expenses. For short-term investments, well, it's an investing activity. Here I went from 100,000 to 40. And what I'm going to do here is I'm going to do the opposite to cash, or I'm going to show this here as a debit of 60. And I'm going to make an assumption here that this was a sale of short-term investments here for 60,000. Again, that's an assumption. In reality, you would maybe want to do it a little bit differently, because if there was a gain or loss or the like, but we're using here a more simplified example. Land went from 100,000 to 25,000. I need a decrease of 75,000. And again, I'm going to make an assumption that this is going to be the sale of land here of 75,000. Okay. For equipment, and this is why it's important that we deal with the additional information first. If I would have just said equipment increased by $350, that's not the correct answer. What I need to do here is I need to say, okay, what is going to be the amount that I need to use here to balance this equation? So it's going to be 400,000 minus 35,000, or 365,000 less 650, or 650,000 minus 365,000, or 285. Does this work? Well, if I take 300 plus 100 plus 285, I get 685, minus 35,000 gives me 650,000. So I know it's worked. And what I do right here is I do the opposite to cash. And I'm going to call this right here a purchase of equipment. Okay. Now, when it comes to accumulated depreciation on equipment, what do I need to do in order to balance my T account? Well, here I have a beginning balance of 50, but I sold some equipment. So here, to balance this T account, this is going to be 50,000 minus 18,000, or 32,000. And to get from 32,000 to 200,000, I'm going to need 168,000. And just to make sure I'm doing this correct, 50,000 plus 168 is 218, minus 18,000 is 200,000. So right over here, what I'm going to do is, I might be running out of color soon, but as you saw in my other video, what's very important about accumulated depreciation is we don't say that this is an increase in accumulated depreciation. This is what we call depreciation expense. I'm going to show this here at 168,000. My next one is accounts payable. What do I need to do to get from a credit of $1,025,000 to an ending credit of $240,000? Well, I'm going to need an adjustment here of $785,000. I do the opposite to cash, or a credit, or a credit to cash. And when I describe this, I'm going to say that this is a decrease in accounts payable, which is what this is. Accrued liabilities went from 1.3 million down to 300,000. So here for accrued liabilities, I'm going to have a decrease of $1 million. I do the opposite to cash, or I'm going to show here a credit to cash. I'm going to say here a decrease in accrued liabilities of $1 million. I then come down here to unearned revenue. I will go from 500 to 600. So here I need a credit of 100,000, a balance. I'm going to do the opposite to cash. And since this is a liability, this is going to be an increase in unearned revenue of 100,000. My bonds payable account is balanced. My discount on bonds payable is also balanced. Remember, I have the issuance plus the non-cash gives me the total. Here is the bond issuance discount. Common stock at par and additional paid in capital common stock have not changed. My retained earnings has an ending balance of $1,375,000, so that is balanced as well. Wow, this is a lot of fun. Okay, so now that I've gone through and done all of these different things, what I now need to go through and do is to determine what was my net cash from operating activities. And so here, what I'm going to do first is I'm going to total up my debits and my credits. And so I have here $728,000 in debits, and I have $2,015,000 in credits. So I have a net credit balance of $1,287,000. So this is going to be, because it's a credit balance in cash, this is going to be net cash used in operating activities. So that's my description. When it comes to investing activities, right here, I'm going to move these guys down a little bit just to give ourselves some more room. There we go. Okay. So what I'm doing here in operating activities, I'm going to go ahead and total these up. So I've got here since I have a net credit balance, I'm going to say here net cash used in investing activities of $138,000. Lastly, for financing, what I'm going to do here is I'm going to go ahead and add these up. And in financing, because the number is a debit or a positive amount, I'm going to have here total net cash provided by financing activities. Okay, now for the big drum roll to make sure we've gone through and we have done all of this correctly. Move some friends down here just for a little bit. Okay, to make sure we've done this correctly, what I need to look at is I need to look at my net cash used in operating activities, my net cash used in investing activities, my net cash provided by financing activities, And we'll make a little T account right here. And so my net cash used in investing was $1,287,000. My net cash used in investing was $138,000. My cash provided by financing activity was $450,000. So my total change in cash right here is going to be $975,000 negative. So my net decrease in cash is going to be $975,000. So once I've gone through and I've done the T accounts, it should be relatively easy to go through and follow. Now, let's go ahead and start working on the statement. So when we're going to the statement, all we're really doing is we're essentially over here and just kind of putting into proper wording the work we've been doing over here. So, and let's go ahead and start this up. So my operating activities, my net income, which is here, and I have this net income / net loss because you essentially choose the one it should be, and then you kind of go from there. And this is going to be adjustments to reconcile net income to net cash from operating activities. So I need to give myself a little bit more room, or actually I should say a lot more room. So I'm just going to pause right here while I make these adjustments to my Excel sheet. Okay, we're back. So right over here, I'm going to show here net income of $350,000. Now, again, when I'm showing amounts on the statement of cash flows, whenever I see a debit to cash, it's going to be a positive amount. If it's a credit to cash, I'm going to show it as a negative amount. So here I have loss on sale of equipment, and this is going to be simply $10,000. Here I had a gain on sale of equipment. This will be a negative $5,000 because it is a credit balance. I have a decrease in accounts receivable. This will be a positive amount. I had an increase in inventory. And let's kind of go take these guys here. So I had an increase in inventory of $200,000, which I'm going to show as a negative. I had an increase in prepaid expenses of $25,000, which will show as a negative. My depreciation expense has a debit balance, so I'm going to be showing that as a positive. My decrease in accounts payable and my decrease in accrued liabilities will both be negatives. My increase in unearned revenue will be right over here. So when I add all these up, I should be getting a negative $1,287,000, which I do. So I'm going to call this net cash used in operating activities, $1,287,000. Okay. We're now going to do the same thing for investing activities. Proceeds from the sale of equipment. And for my class, I want you to show each of these separately. You cannot combine them together. Okay. So right over here, I have proceeds from the sale of equipment. It's a debit, so it's going to show as a positive amount. Sale of short-term investments, sale of land. And then over here, I have a purchase of equipment, or it's going to be a credit of $285,000. So this is going to be net cash used in investing activities because the overall number is negative. So when I add these up, I'm going to get a total right over here of $138,000 negative. And again, if I've done this correctly, the numbers here should all be lining up. For my financing, I had a sale of bonds and I'm crediting it. So over here, I've got dividends. So my sale of bonds is going to be $500,000, which were my bond proceeds. And then here for my dividends paid, it's going to be a negative 50. And this one is going to be net cash provided by financing activities. Why is it provided by? Because the amount overall is a positive $450,000. So when I add up 1,287,000 plus the 138,000 plus the 450, I get to my 975,000. Note that this net increase in cash, this also ties in with what we were showing earlier, the $5 million beginning cash balance and the $4,025,000 ending balance. So this is going to be a net decrease in cash. And then lastly, because I went over here, I had a non-cash transaction. This is shown below the statement of cash flows. So once I have my ending cash balance, I then start describing what were the non-cash transactions so that a shareholder can understand what did not impact cash and impacted essentially the balance sheet. So that's it for today. Thank you for bearing with me. This video is probably way too long, but have a great one. I'll see you next time, and please do not forget to like and subscribe, and I'll see you next time. Take care.